Welcome to another AmCham Hong Kong event. My name is Richard Volsteck. I'm president of the American Chamber here in Hong Kong. And on behalf of our board, I'd like to give hearty welcome to all our members and guests today for a very special event for a long-time interlocutor with AmCham Hong Kong, in fact with AmChams in the region, Nick Lardy. A couple opening just comments. If you've got mobile devices, and who doesn't, please put them on silent and no email beeping kind of things, and that sort of thing. Would be much appreciated. If you look around the room, we have some sponsored tables by KPMG and Jefferies, United Overseas Bank. We find that many of our companies like to do sponsorships of tables for events such as this, not only for their own staff and colleagues, but for their clients. And so very happy to see and thankful for the sponsorships from both, as I say, KPMG, Jefferies Hong Kong, and United Overseas Bank. I'd like to take this opportunity to introduce people at the head table. Nick Lardy will be introduced at length around a little bit after 1 o'clock when we start the program. But there's a few other people you might want to meet, not during the speech, but after the session, that are sitting at the head table. So, first of all, our co-host for today, KPMG, is represented by Irene Chu, a partner for KPMG, and she will be introducing our speaker a little later today. Next to her is Ewan Copeland, who's vice chairman of the Global Corporate Bank for Citi and a member of our AmCham board. Next to him is Robert Wohl, a partner for Deakins. Next to him, Frank Wong, who is president of Asia Scholastic Inc., which is, they've published small publications like Harry Potter series and so forth. He's also an AmCham governor. Next to him is Sept Peterson, partner for industrial practice Heidrick & Struggles, Hong Kong. Seth is the chairman of our AmCham China Business Committee, which is an extremely active group in the chamber, our committee, and we have literally hundreds of functions during the course of the year, individually or in tandem with other committees. If you're interested in China business and not a member of this committee, you might want to check with him later. Also, Patrick Wu, President and Managing Director of American Appraisal, long-term leader in our Trade and Investment Committee, and is all-around good guy. So another one good person to meet. Next to him, Tom Gorman, who is Chairman and Editor-in-Chief of Fortune China, was also a past chairman of AmCham back in 1995. We are blessed at the Chamber to have 14 past chairmen still in town. For those of you who are newcomers, Hong Kong is a very difficult place to leave, so early warning. And but by having this legacy leadership in the chamber, it just has an incredible resource for us throughout the year. Next to Tom is Catherine Simmons, Managing Director and Head of Government Affairs, Asia Pacific for Citi. And next to her is Michael Kleibanner, Regional Head and Director and Head of Research, Greater China for Jones Lang LaSalle. So as you can see, even at the head table, we have a good mix of industries. Only one further message from me that for the people wearing gray name tabs which are not members, there's, of course, we have counseling services for you. I have staff in the back of the room. But also, I want to just mention one thing about the American Chamber of Commerce in Hong Kong, and that is we're an American chamber with international characteristics. Half our members do not have American passports. We have many, many members of the chamber who have another membership in their national chamber, Italians, French, Japanese, what have you, which we encourage, by the way. People want to get together in national groups. But the American chamber is really like Hong Kong. It's a melting pot. It's a mixing place with a great range of backgrounds, ethnic, religious, professional, travel, and it just, you can tell it in any kind of discussion, whether it's a cocktail party or an event we have. So if you're not a member, look into this, take advantage of it. We'd like to have you join us. With that, please begin your meal, and we'll be back around 1:10 for introduction of our speaker. And as always, vigorous Q&A, and we'll be out here by 2 o'clock. Thank you very much for coming.
Ladies and gentlemen, while you're still enjoying your dessert, I'd like to take this opportunity to introduce our speaker today. Just a little self-introduction, Irene Chu from KPMG. Very glad and great pleasure to be sponsoring the event today. And like most of you who have been working, doing business in Hong Kong for many years, you all understand that China has been a big driving force of the economy in Hong Kong. And even after, I was in Toronto for many years, and I've been back over 14 years. Even of all these years, we're still trying to understand China, and this is a very complex economy. At the same time, it's growing very fast. So it's great pleasure today to introduce our speaker today, who is an expert in China. So let me just read out his achievements and of all these years. Dr. Nick Lardy is the Anthony M. Solomon Senior Fellow at the Peterson Institute for International Economics. He joined the Institute in March 2003 from the Brookings Institution, where he was a senior fellow from 1995 until 2003. Before Brookings, he served at the University of Washington, where he was the director of the Henry M. Jackson School of International Studies from 1991 to 1995. From 1997 through 2000, he was also the Frederick Frank Adjunct Professor of International Trade and Finance at the Yale University School of Management. He's an expert on the Chinese economy. Dr. Lardy also published many books, and I'm going to read out all the recent books and earlier years that the books that he published. His most recent books are Market Over Mao. Copies of the book you can also buy at the reception outside. The Rise of the Private Business in China, and Sustaining China's Economic Growth After the Global Financial Crisis. That's 2012. His previous books include The Future of China's Exchange Rate Policy in 2009, Integrating China into the Global Economy in 2002, China's Unfinished Economic Revolution in 1998, China in the World Economy 1994, Foreign Trade and Economic Reform in China 1978 to 1990, Agriculture in China's Modern Economic Development 1983, and Economic Growth and Distribution in China, 1978. So Dr. Lardy's study on China can trace back many decades. So he's one of the earliest, I think, American who's got a very strong interest in China. So Dr. Lardy is a member of the Council on Foreign Relations and is a member of the editorial boards of Asia Policy and the China Review. He received his BA from the University of Wisconsin in 1968 and his PhD from University of Michigan in 1975, both in economics. So let's welcome Dr. Lardy. Thank you.
Well, I want to thank Irene for that very comprehensive introduction, and thank Richard for inviting me to speak with you today. It's a great opportunity to talk about some of my new research that's reflected in the book. And just to give you the kind of main takeaway at the beginning, this book basically argues that most of China's economic growth, most of the growth of employment, most of the investment that's going on now, most of the exports are coming out of private businesses in China. I think there's probably a better understanding of this here in Hong Kong than in Washington. In Washington, the conventional wisdom is that China is still a very state-dominated economy, state capitalism, and of course that's a view that's been pushed by The Economist, and some other fairly well-known publications. But I think it's the rise of the market and the rise of private business is responsible for most of China's economic success. And where the state has tried to use industrial policy in a heavy hand, I'm going to argue in a few minutes that I think those efforts have basically failed. But I'm going to ask you to look at a few of the slides. The basic foundation was laid when they gave up state control of prices. At the beginning of the reform period, the State Price Commission set the price of almost everything without any regard for scarcity. And as you can see from the diagram, once you get into the 90s, this began to fade away. By the time you get to the late 90s, most prices were being determined in markets and by supply and demand. The other thing that's very important to recognize is that most of these markets were very competitive. This is a very disaggregated analysis looking at how concentrated production is in various subsectors, very disaggregated. As you can see, the not concentrated sectors accounted for 73% of the industrial sector in 1998. If you look at the United States for the same year, the number is 72%. So it's about as competitive a market as we see in the United States. And of course, that means there's not much evidence of market power. You don't have a lot of companies that have the ability to raise prices, so the market prices really do reflect relative scarcity rather than market power. The other fundamental that I lay out in the book, which is kind of a foundation, is that the other major thing that changed was the financing of investment. In the 80s, we still had a system where most investment was being financed through the state budget. That began to fade away. In the 90s, you could see here 40-some% of investment was being financed from retained earnings. By the time we get to the 2000s period, 71% of all investment by non-financial corporations is undertaken by retained earnings. And even in the last few years, unfortunately, these data come out with a lag, so it only goes through 2011. But even when we had this huge increase in credit growth starting in the latter part of 2008, it was still the case that well over half of all investment was being financed from retained earnings rather than from bank loans, raising money on the equity markets, or issuing debt. Now, the last fundamental is, this is looking at the industrial sector. The reason, one of the main reasons the private sector has done so well, and I'll show you some evidence of that in a minute, is that for all the years for which we have data, private companies have had a higher return on assets than state-owned companies. There was a beginning of a little bit of a convergence back in the middle of the last decade, but over the last 6 or 7 years, you can see the gap has widened, with private companies now earning almost 3 times as much on their assets as state companies. So that's the fuel for the economic growth that the private sector has been able to achieve over the last 3 decades or so. Next, I'm going to turn to talk about some of the myths that have become fairly common, particularly in Washington, about the nature of the economy. Then most of them focus on the role of the state. So the view in Washington still is that China is dominated by state-owned companies. This congressional committee, this Economic and Security Review Commission, arguing a couple of years ago that the state picks the winners and creates so-called national champions. So I'm going to look at this from several perspectives. I'm going to start with output. Here's the red line that is showing you the share of output by value that is coming out of state enterprises, and you can see it's gone from about 80% when reform began down to about 25% for the most recent year for which the data have been released. And if you just look at manufacturing, which is the most liberalized sector, obviously the government is still restricting entry into utilities. There are some very substantial restrictions on entry into mining, which includes oil and gas, upstream oil and gas. But manufacturing is pretty liberalized, and there the role of the state has really diminished fairly dramatically. These state-owned companies are only producing about 1/5 of the output of the manufacturing sector, which still accounts for more than 30%. The manufacturing sector still accounts for more than 30% of GDP. If we disaggregate into the 40 sectors that the Statistical Bureau gives us information on, you can see that the state remains very dominant in the utilities, electric power, upstream oil and gas, and water supply, and so forth. But it falls off fairly rapidly, even in some sectors where you might suspect the state has a very substantial role, like steel, for example. The role of the state is now just a little bit over a third in terms of production. The bottom line is showing us that there are 24 more sectors that if I put them all on the diagram, you wouldn't be able to read it, but there are 24 sectors where the state share is less than 15%. The average is 6.5%. These are things like apparel, furniture, and so forth, where state companies are producing less than 2% of the output. So in terms of output, I think the state has been being displaced. It's really not privatization of state companies. It's just that private companies are more efficient, they grow more rapidly, and so the footprint, if you will, of the state companies diminishes over time. Investment. I want to look at manufacturing since that's critical, and the key here is that state companies are only responsible for about 10% of all the investment that goes on in the manufacturing sector. Domestic, indigenous private companies are doing over 70% of the investing. If you wanted to add in foreign companies, most of which are private as well, that would add on an additional amount. So the state, now we've looked at output, we've looked at investment. Then I want to look at employment. The black bars are the millions of people employed in the state-owned sector, and the red line is showing us what they represent as a share of the workforce. And I think it's fair to say that when reform was getting underway, state companies were the dominant employers in China. There was some collective employment, but collectives were typically controlled by local governments, municipalities, sometimes provinces, and so forth. And the key takeaway here is in the red line. State companies, state-owned companies, this is all kinds of state-owned companies in services, manufacturing, and so forth, only account for 13% of employment in China today. So it's a very, very dramatic shrinkage, and it's been steadily going down. This little uptick at the end is an anomaly that I won't go into. The long-term trend continues to be a shrinkage in the role of the state enterprises in employment. Another area the state is fading away is in exports. You can see from the diagram, if you go back to the mid-90s, state companies were producing about 2/3 of all of China's exports. From the mid-90s, they steadily lost share, now down to around 10%. Originally, foreign companies, foreign-funded enterprises picked up the slack and made China a big exporter. But most people have not noticed that the share of China's exports being produced by these foreign invested companies actually peaked in roughly 2005 and has been coming down gradually since then. And we have a huge pickup in exports coming out of private firms. Private firms were not in the export business until beginning in the 2000s. Now they're producing more than 2/5 or around 2/5 of the exports. And if you look at it on the incremental basis, since the foreign firms are exporting a little bit more, but their share is coming down. If you look at the year-by-year growth of exports, the private firms now dominate. So in exporting as well, so now we've looked at output, we've looked at employment, we've looked at investment, now exports. So basically, the evidence shows that the state sector is, at least in the aggregate, much less powerful than it used to be. Now, the next thing I want to look at, another misconception, another myth, is that these state-owned enterprises are very powerful. You see James McGregor, whom some of you probably know. Their profits, especially the central SOEs, are astronomical. And the economists telling us, yes, there are fewer state-owned companies than there used to be, but they're more powerful than ever. So I started looking at the data, and of course, the background you're all familiar with, so I don't have to go into this. In the Hu Jintao-Wen Jiabao period, we had the formation of SASIC. We had a lot of industrial policies that seemed geared towards prioritizing the development of state companies at the expense of private companies, at the expense of foreign companies, the indigenous innovation policy, the strategic emerging industries plan, and so forth. So there seemed to be some evidence that they were moving in this direction. So the first thing I looked at is, well, let's just look at all of the industrial sector of state companies versus private companies and see what the profit margins are. If these state companies really have so much market power, they're going to raise their prices and earn more. And I can tell you, if you take the average over this whole period, state companies have profitability that is 0.2% higher than private companies. And as you can see from the right-hand side of the diagram, the profitability levels are almost identical the last few years. So this does not look like a picture supporting the idea that state companies are very powerful and that their power has grown over time. Of course, this is looking at all the companies, and some of the charges are tied to the SASIC companies. So I went and looked at just the SASIC companies. This is all official data out of the SASIC yearbook. And again, it seems to support the idea, yeah, their profits went way up. From 2003, when SASIC was formed, up to 2013, the profits of these companies, the small number, these are the crown jewels, so to speak, the oil companies, the telcos, et cetera, their profits quadrupled. But as I like to remind people, I don't need to do it so much here, but everything's growing rapidly in China. And if you look at the share of profits earned by this group of companies under SASIC, their share of profits actually went down. In 2003, it was 11%. In 2013, it was 10.5%. So they had all these industrial policies that were supposed to help them to become more profitable and bigger, but at least as measured by the share of output, the share of profits that they're generating, it doesn't seem like they did so well. But for me, the real nail in the coffin is to look at the earnings of these companies relative to their cost of capital. And as you can see on the left-hand side, there were a few years, and the data here only go back to 2005. In the middle of the last decade, there were a couple of years in which these companies were earning a return that was roughly equal to or maybe even slightly ahead of their cost of capital. But in the last 6 years, the return on assets of these companies has declined dramatically. In other words, they kept up their profit growth by adding to assets at a very rapid rate, and their efficiency went down. And so today we see that their return on assets is barely more than half their cost of capital. Well, to me, this is not exactly, you can't be a national champion in my book if your return on assets is less than half the cost of capital. My view is that these firms are, on average, maybe there are exceptions that some well-managed companies, but on average, these state companies, these big state companies under SASIC, are a drag on China's economic growth. So I'm not of the view that the Hu Jintao, Wen Jiabao period resulted in a huge increase in profitability of state companies and the creation of national champions under the leadership of SASIC. So that's myth number 2. Now I'm going to go to number 3, and I think even some people in this room might be surprised, but the conventional wisdom has been repeated so frequently, even in such great publications as the Financial Times, that the private sector is starved for cash and state-owned companies get easy access to loans. But no, people don't look at the data. And you might ask, how do these private companies grow so fast if they don't get any credit? Well, part of it is higher returns and retained earnings. But let's look at the data. This is the data on the stock of loans outstanding by ownership. The Chinese central bank has started to release this kind of data. And you look at the left-hand side in 2009, well, the state does get a lot of the credit. The private sector is 26%. Then you look at the right-hand side 3 years later, the private share has grown quite a bit. It's up to 36%. Now, once you take into account the fact that in 2009, credit outstanding was already 120% of GDP, to move the private share from 26% to 36%, it means the flow going to the private sector has to be quite a bit higher than these stock numbers. And fortunately, the authorities have given us those data. And you can see here in 2010, 11, and 12, the share of loans going to enterprises that are going to private enterprises is a little over 50%, roughly 52%, and the share going to state-owned companies is, something in the neighborhood of about 32%. So private companies are getting much better access to capital than state companies, at least in recent years, although you can see that there's a legacy problem here. Historically, state companies did have a lot better access to credit. That's how they had 56% of all the credit outstanding in 2009. But their shares obviously coming down. This does not mean that the system is perfect, of course. I'm of the view that the private sector is now contributing about 2/3, maybe even as much as 3/4 of China's GDP, and they're only getting about half the lending, so I would say the private sector is still underserved. But it's not the case, as the Financial Times was suggesting, that private companies are starved for cash and that state companies have easy access to credit. Why do banks lend so much money to private companies? Well, it goes back to their return on assets, and one of the measures of credit worthiness is what's the interest coverage ratio. If you look at your pre-tax earnings relative to what you have to pay in interest, you can see that private companies have pretty consistently been more credit worthy than state companies. There was a brief period where they kind of converged, but the difference now is 2 to 1. In other words, private companies have a twice as great an ability to pay, to amortize their loans, pay the interest and so forth as state companies. So I think as the banking system has become, I know it's a lot of critics of Chinese banking system. I was one and myself back in the 90s, but I think there has been a considerable transformation of the banking system, and they're now directing more credit to more credit-worthy customers rather than just lending blindly to state-owned companies. So that's, I think that was myth number 3. I'm going to do one more, that the state was resurgent in the Hu-Wen era, and that they returned to prominence under under Hu Jintao and Wen Jiabao. If you look at the growth of value added, focus on the right-hand side of the diagram, the comparison of private companies versus state companies. It doesn't matter what time period you look at. The private companies are growing twice as fast, and this is measured by value added, which is the gold standard for measuring output. This is what goes into GDP statistics. Whether you're looking at pre-global financial crisis, post-global financial crisis, the first half of this year, any way you look at it, private companies are growing twice as fast. This is why the state share continues to decline, as I showed you in the earlier diagram. So I don't see much evidence here that there's a resurgence under Hu Jintao or Wen Jiabao, or that starting in the global financial crisis, when there was a big amount of credit being extended, that it was going to state companies. I already showed you that's not the case, and it's certainly not reflected in this pattern of growth that's summarized here. Well, I want to switch gears now and look forward. The title of my talk was China's New Growth Model, so I've kind of laid the foundation. It's a much more market-driven economy than many people have recognized. And I think the third plenum is a further acceleration in this direction, the statement that the market must play a decisive role in the allocation of resources, and that we must eliminate all but natural monopolies, as they said almost a year ago. If you have been listening carefully, some of the evidence that I've been focusing on is restricted to the manufacturing sector and industry more broadly. I haven't said so much about services, and I think the big monopolies, of course, are in services where the state still dominates: financial services, telecommunications, other modern business services. And one way of capturing that is to look at the role of the state versus private companies in investment in services. And remember, in manufacturing, the state is now down to being responsible for 10% of investment, but in services, it's 4 times bigger. It's 45%, and it's substantially more than the investment being undertaken by private companies. The other takeaway from this diagram is there's not much of a trend here. You look at the black line, the private, maybe it went from 32% to 36% over the period of the 6 years we're showing here, but the state seems to be in a dominant position, and it's not eroding at a very rapid pace. And that reflects, as I said, the fact that there are regulatory barriers that make it difficult for private firms to enter into the services that I mentioned. And this is particularly obvious if you look at the broader range of what many people call modern business services. As you can see, the 4 components here. If you look over, obviously the state dominates very heavily in financial intermediation, information technology, software, and so forth. The only sector where the privates are a little bit ahead is in business leasing and business services. So the state really does still dominate much more in this sector than it does in manufacturing. Now, let me tell you two more things that are relevant for kind of looking forward to the new growth model. Investment in services is extremely important in China today. Over half of all investment is going into the service sector. This is very different from 15, 20 years ago when most investment was still going into the industrial sector. The other thing to keep in mind is we don't have very comprehensive data on productivity of state versus private, but the data that we do have shows fairly clearly that the productivity of private service providers is at least twice that of state service providers. So I think there is a massive misallocation of capital going on in the service sector. More than half of the investment in the economy is going into services. A very large share is going in a direction where the resources are being used relatively inefficiently. So I see the service sector as a huge opportunity. If the leadership wants to keep China's economic growth going, the best way of doing that is to demonopolize, as they've already recognized, allow the private sector to enter into the areas where they've been restricted in the past, so you get the efficiency gains of the private sector. This would allow China to maintain its growth at a fairly high rate, even as it brings down the rate of investment. I think everybody agrees that the investment rate is too high. Its growth has been credit-driven, particularly in the last few years. Many people say, well, as credit growth slows down, investment's going to slow down, and the whole economy is going to slow down, perhaps dramatically. Well, if you begin to reallocate in favor of more efficient private service providers, also upstream oil and gas, which is very inefficient. 2 of the 3 companies in that sector are earning return on assets that's embarrassingly low. So if you open those up, I think you'll get more efficiency and you can maintain growth with a lower rate of investment that we've seen. There's one other important reform that is going to supplement this, complement this, and that is the reform of interest rates and the reform of the financial sector more broadly. China's had a highly repressed financial system for quite some time. Real deposit rates earned by savers are down about 320 basis points in the last 10 years compared to the previous 8 or 9 years. And that has made the cost of capital very cheap in China. You look at the real cost of capital, which is just the average lending rate minus the GDP deflator. It's much cheaper in China than anywhere else. This is why investment has gone through the stratosphere. If you can borrow at a real rate of 2%, there are a lot of projects that look profitable. We know, or at least I believe, that if the ceiling on deposit rates is gradually phased out, rates that banks pay are going to go up. We look at wealth management products. We could look at the Alibaba money market funds. They're paying significantly higher interest rates at a couple hundred basis points, maybe a little bit more in some years or some months. So I think the interest rates that banks would have to pay would go up. We have some bankers, if I'm wrong, I hope they'll contradict me. When banks have to pay more on their liabilities, they will seek to earn more on their assets. And so I think the cost of money will go up. How does that feed into the services story and the demonopolization? Well, I think I've already showed you the evidence. The ownership, the parts of the economic system that will be able to afford to pay somewhat higher interest rates is basically the private sector. They've got the higher return on assets. They're in a stronger financial position. So I think you liberalize the financial sector, even the amount of credit going to state companies will go down from where it is now. The roughly third or a little bit more that they get, and the share going to private companies will go up. This will facilitate the entry of private companies into the areas, the sectors and the subsectors that they have not had access to. So I think this leads to a growth model that will be, services will be more important. Growth of employment in the modern sector will be more rapid because service sectors are more labor intensive. The wage share of GDP will go up. Consumption growth will improve compared to what its private consumption growth will increase as a share of GDP, and China will transition away from this very capital-intensive investment/credit-driven growth that we have seen for much of the last 5 or 10 years. So I think that's the new growth model. So my conclusion is it's the rise of market forces and private businesses that has driven the growth. that China is not an example of, or certainly not a successful example of state capitalism, if there is such a thing. There was no resurgence of the state in the Hu Jintao Wen Jiabao period, even though a lot of people were talking about, Guojin Min Tui. I think it's the opposite as the subtitle on my book shows. It's Min Jin Guo Tui. The private sector is doing a better job of servicing, the banking system is doing a better job of serving the private sector than the critics suggest. And I think the way forward is to demonopolize upstream oil and gas, modern business services, liberalize deposit rates, and the financial system more generally. That is the way forward, and I think that is what Xi Jinping and Li Keqiang are going to try to do. Well, I hope I've left a little time for questions.
Candid, succinct. We have time for questions, and raise your hand. All I ask is that you state your name and the company you're with and so forth. Start here.
Great. Conor O'Mara, Jefferies. You were mentioning the raid on the Alibaba account, and I'm just trying to figure out how politically does liberalization happen. So if we take financial services as an example, the Alibaba and Tencent accounts, they pay higher rates. They allow people like students to have bank accounts that can't actually have bank accounts under the financial services. I presume MIIT and NDRC likes that, but what's happened is the banks didn't like it. They went to the CSRC and have put in lots and lots of restrictions on this money market fund development. So there are always lots of different competing interest groups within China. So how do we liberalize? Is it basically the state council comes down and just tells all them to work together, or what's the process?
Well, I agree. I think the most significant restriction that's been put on is, restrictions on the pace at which you can take money out of these accounts, which makes them, less like demand deposits. So they're somewhat less attractive, and it's been reflected in the fact that these accounts are growing less rapidly than they were, 6 months or a year ago. Nonetheless, I do think we are de facto getting some interest rate liberalization because we now have a significant chunk of money in these kinds of accounts that is, where they're basically competitive environment and interest rates are being determined in that market. And some of this activity, of course, is being done directly by banks, so at least some of their funding costs have gone up, and I think that's a plus. It means banks are getting some experience in dealing with a more market-driven funding process. So I think it's a plus. I think what's going to happen is what they've said. They want to get their deposit insurance scheme in effect before they liberalize completely on the deposit side. They have said many times they hope to do that by the end of the year. I think we're beginning to run out of time, so maybe it's not going to happen this year. I hope it'll happen next year. And there are a lot of, the chairman of the Chinese Banking Association stood up and publicly said this liberalization of interest rates is no good. Credit growth will slow down, the economy will slow down, there'll be more unemployment, there'll be social unrest, it's the end of the world. It sounds like what some financial institutions in the US have been saying about increased regulation and how bad it's going to be. But I think the top leadership is determined to push through on this, and so I'm expecting to see some movement. By the way, I'm not in favor of overnight liberalization of the rates. You've got to give the corporate sector time to adjust to a higher cost of funds. There's a lot of leverage in the system, so they need to, they can still have a benchmark ceiling on deposit rates, but they've gone from 1 to 1.1 times, and they need to go 1.2 and then 1.3, and then after some period of time, get rid of the ceiling altogether.
Thank you, Dr. Lardy, for that very interesting analysis. Robert Greaves, Hamilton Advisors. There are two areas I'd like you to focus in on a little more that Western observers talk about, and they usually are preceded by the adjective chronic. China's chronic debt and China's chronic overcapacity. How bad is the debt situation in China, and how bad is the industrial overcapacity, in your opinion?
Well, there's no question that the increase in debt to GDP since 2008 has gone up dramatically, more dramatically than it ever has before in China, and almost more rapidly than any other country, any other emerging market that we have data for. So certainly the alarm bells are going off. I think the authorities are slowing down the growth of credit. We've seen that. Still growing, but not as rapidly as back in 2010, for example. So since roughly the second half of 2013, credit growth has moderated. It needs to moderate more and for a sustained period of time. And one of the things I find encouraging is that even though growth is slowing down now, they are avoiding kind of a massive, increase in money supply, a general monetary easing. They're doing very selective things, and I hope that's the pattern that continues. So the aggregate numbers, as I said, are not encouraging. On the other hand, a lot of the credit has gone to private companies that have fairly high returns. So maybe when you disaggregate, maybe the situation's not as bad as the aggregate numbers would indicate. I think the share of credit going to the private firms has gone up, and they have much higher returns, they have much higher interest coverage, so maybe the risks there are less than perceived when you look at the aggregate data. Now, the second part of your question was?
Overcapacity.
Overcapacity. Well, I think, steel is the great example. And, for 7 or 8, 9 years up to around 2007, this was covered in the piece that I wrote for the FT, which I think you got copies of. Steel production was growing at 20-25% per year. Since that time, it's growing at 6%. This is a massive deceleration. And if you've been operating in an industry for a decade that's growing at more than 20%, a lot of investment plans get put in place, and then when demand starts slowing down, all of a sudden you have excess capacity. It will take a number of years for that to be absorbed in a lot of the sectors where we see the excess capacity. So I think we're going to be in a period of, strains on profits in the sectors where, we already know the steel capacity, state-owned steel companies have been losing money since, I can't remember, 2011 or 12, and that could continue for a few more years. So, maybe it'll be good. Maybe we'll be, pushing for consolidation, exit of least efficient firms. Maybe we'll see more Sinopecs selling off assets to become or remain economically viable. I hope that's the model we see, rather than the state banks coming in and then flooding these companies with more credit.
Thank you for the presentation, Dr. Lardy. I wanted to ask you a question about debt flows. In terms of the data quality, I'm in real estate, we get questions about data quality all the time. Where do loans to, say, the local government financing vehicles show up? Where do loans that go to sort of quasi-state-owned companies, so publicly listed but still basically dominated by the state, do those show up in private or state? And then regardless of that, even if the state sector receives fewer than 50% of bank loans, it's still disproportionate to the share of the economy they represent. So they're still getting a disproportionate amount of debt flows.
Right. This is a very good question and brings me to a subject, gets me an opportunity to go down into the weeds a little bit. The Chinese never gave us data on lending by ownership until starting in 2010. You could get it, how much was going to commerce, how much was going to manufacturing and so forth, but not by ownership. The authorities have introduced this idea of control. So a state-controlled company, a guoyou kongwu jie, it's all of the traditional state-owned companies which haven't been corporatized, plus all of those that have been corporatized have become limited liability companies, some of which have listed on various stock markets. If the state is the sole majority or dominant owner, it is classified as a state-controlled company. And even, I actually went back, or had my researchers look up in the microdata set, well, how do they classify the 50-50 JVs that SAIC has with Volkswagen and General Motors? They're classified as state-controlled. So if the loan is going to a company that meets those definitions, it's in the state-controlled column. If it's the same principle applies for privately controlled. It goes into the private column. I think this is a reasonable definition. There may be cases of ambiguity, but I think that's what we want to look at. Who's the dominant owner? Who's the majority owner? So this has helped quite a bit because we used to have this huge swath of limited liability companies that we didn't know anything about who really owns them. And so now they have separated them out into the various ownership categories based on this concept of control. People make big mistakes. I just discovered a book that an economist in Europe has written. He says the state companies only have 26 million employees. Well, he's only looking at the traditional SOEs because a lot of the labor, you have to dig and dig and dig. When you dig and dig and dig, then you add on the employees of limited liability company where the state is in control, it's 45 million. So, this whole book is based on this concept of control. In a few cases, I've had to use data just on registered private firms, which is a subset of the whole universe of private controlled firms.
Yes. Oh, excuse me. Mort.
Mort Holbrook, Hong Kong America Center. China's had extraordinary economic growth for an extraordinarily long period of time. I don't think anyone predicted it in 1979. Perhaps your book in 78 did, but I don't know. But they've surmounted what others thought were crises in 1997 and 2008. What does the United States have to learn from this extraordinary success, if anything?
Well, I think that's a good question, and I quite frankly, one of the things that I was trying to get at in the piece in the Financial Times yesterday is a lot of people in Washington who think the state is controlling everything and that this is a state-driven economy tend to think that this can't last. We don't have other good examples of state-driven economies that have been successful over a long period of time. So this is a bad model that's going to eventually go off the edge. So I think these people have not really come to grips with the fact that China has a reasonable prospect of continuing to grow fairly rapidly because it's largely a market economy, and if they carry out the reforms they're talking about, it will be even more of a market economy. The growth will be more sustainable, more efficient, and I think that's the mentality that our policymakers in Washington should have. They should be thinking more about the probability that this growth could continue, partly, as you say, based on, at every point on the last 35 years, you can point to a litany of challenges, problems, et cetera. But you can call it muddling through, or maybe it was great luck or whatever. They've still continued to grow fairly rapidly. And so I think we need a more realistic assessment of what the real sources of growth in this economy are.
Thank you, Dr. Lardy. Bill McGrath from BTG Pactual. Just two things I'd like you to comment on. One is we saw in the newspapers a few days ago that China's economy in the last 2 quarters, we've seen negative productivity. And they've highlighted that this is the first time we've seen that since the Cultural Revolution. And is that a sign of China hitting the Lewis turning point? And second question is, Huang Yasheng highlights that China's workforce is relatively uneducated. And if you look at the education levels of China's workforce and compare it to Korea's 20 years ago, he highlights that Koreans were 80% having secondary education, and China's is much closer to 50%. So if the answer is services to drive the economy forward, do we have a labor force that's educated enough to actually work in services?
Well, on the first point, on the recent data that came out in August, I don't think they're showing negative productivity. They're showing the slowest growth of industrial production that we've seen in many, many years. So the IP growth has slowed down to whatever the number was, 6-point-something%. And the industrial sector has been the driver of Chinese economic growth, and they're certainly not going to hit 7.5% on GDP unless industrial production is growing at, in the neighborhood of 9%. Because agriculture never grows much more than about 3%, and services are doing a little better recently. But I always hesitate to get involved in looking in great detail at the monthly data. It's very volatile, and 1 month things are down and people are predicting doom and gloom, and the next month things pick up a little bit and everything's rosy. So I don't to me, the thing that I find encouraging in the current environment is what I said before, that the leadership is essentially willing to accept lower economic growth. They still are talking about 7.5, but you look at the body language for Li Keqiang in Tianjin last week, and it's, maybe it's about 7.5. A little less wouldn't be the end of the world. Employment growth is still very strong, so they're not going to push a wall of credit into the economy, I hope, just to get to some arbitrary number. And there are some strengths in the data that are being released. Consumption growth is still very strong. This has been one of the hallmarks of the economy in the last couple of years. The service sector is growing more rapidly. We're getting as much increase in the modern sector labor force in absolute terms when they're growing at 7 point something as we used to get when they were growing at 10 point something. So the wage bill is increasing, the wage share of GDP is going up, that's fueling more consumption, and consumption is helping to keep the economy growing. Now, I haven't read this new piece by Huang Yesheng, but I'm not sure Korea 20 years ago is exactly the right comparison. It seems to me 20 years ago, Korea was at a higher level of per capita GDP adjusted for prices than where China is now. I think China in the last, throughout this whole period has made major, they've expanded university education substantially. The, participation at the secondary level is a pretty high level. I think China is probably has a much stronger labor force position measured by education and other characteristics than most emerging markets at China's level of economic development. So I certainly think they're going to have the resources, the human resources, to have the growth model that I've outlined. But I'm not an expert on the demographics, so you might take what I say with a grain of salt.
People can ask questions on this side of the room, too. I'm pretty shy over there. So talk out first here.
Thanks for a great talk, Dr. Lardy. Nick Topton, Elite Advisors. Just wondering, over the next 6 to 12 months, are there any specific reform measures, or if you had to say top 3 things you'd be looking for as very good signs? One of the challenges of just observing all of the changes is there's always new announcements, as you were saying, people bullish, bearish, and it feels like we know what they need to do, as you nicely pointed out, and the key areas where they could privatize. But are there any, if you had to narrow it down to say 3 things that we should keep an eye out for, which would be very constructive?
Well, there's always a debate going on. They have got this great blueprint for economic reform. It covers everything from soup to nuts, but how fast are they going to be able to implement it? And the skeptics are saying, well, they're not really doing very much yet. It's too soon to say. Optimists point to a number of things. I tend to be a little bit more in the optimistic camp because I think they have done a number of things. I mean, the Sinopec sale of assets is not something that would have happened a year ago. They've gotten rid of the capital requirements to register as a limited liability company, and we have this gigantic increase in the formation of companies, almost all private. So a lot of private entrepreneurs couldn't come up with the 300,000 kwai you needed to register as a limited liability company. And now there's no minimum capital requirement. So we're seeing a huge increase in formation of companies. Getting rid of those kinds of administrative controls, I think, is very positive. The other area where I think significant progress has been made is China has always had underpriced electricity, underpriced water, underpriced natural gas. Most of these prices now are being raised towards much more, reflecting scarcity values. This is very important because one of the benefits that the manufacturing sector had and the capital-intensive sector had is that they had cheap energy and they used most of the energy, not the household sector. They had underpriced foreign exchange. That's pretty much over. The currency is much closer to an equilibrium level than it was 4 or 5 years ago. The current account is 2% of GDP instead of 10. So some of the structural distortions, if you will, are fading away, and that has continued and to some extent even accelerated under under the new regime. They're giving import licenses to private players in natural gas for the first time. So we're going to have more, the downstream gas business is being somewhat deregulated on gas distribution. It's already private sector's already got a significant role, but now they're getting import rights, direct import rights as well. So you add all these things up, we're still less than a year away from the launching of reforms, so it's probably premature to come to a judgment, but I'm a little bit optimistic. I do think the critical thing to watch is when do they get the deposit insurance scheme in effect, and when do they start liberalizing on the deposit rates. That's probably the single most, in my judgment, I think that's the single most important thing for the reform agenda. There are a lot of other things that would be good to do, like hukou reform, but that's a huge, big structural problem. It's going to take years to come to more significantly liberalize these restrictions on residency. And I think the payoff from some of these things I focused on is going to be more immediate.
Anyone have the first questions? Yeah, okay. Sorry, I didn't see your patience.
Hello, Dr. Lardy. This is I'm Anthony Lee from KPMG, and I actually just recently moved back to Hong Kong from Beijing, and I think after the 18th People's Congress in China, I think certainly the central government in China has outlined a few areas of key focus in the current 5-year plan. And two of the areas that were highlighted that has a lot of prospect for financial services has to do with the pension and medical reforms in China. And I think what they're thinking about in the medical side is both the capacity for care and also the capacity to pay. And also in terms of pension is how do we get off the reliance solely on the social security system in China. So just want to get your views on, what are your views on the future prospects on the reforms in these two key industries? Thank you.
Well, I think this is an area where reforms did get going even 5 or 6 years ago, because they have introduced much more comprehensive medical insurance scheme in the countryside. Typically, historically, there has not been medical insurance in the countryside. So they've introduced this cooperative system where farmers have to pay a small amount to participate. The reimbursement rates are not 100% by any means, but they have been moving up over time. So you have hundreds of millions of people that never had any insurance that now have at least something. And we wouldn't want to have what they have, but for them it's a huge improvement. And the same thing is now happening on the pension side. So I think they're making progress slowly. The expenditures on these programs have risen quite significantly over the last 5 to 10 years. And I think we're going to see more entry of private alternatives, both on the pension side and on the healthcare side. Another reform is that private foreign firms can now have wholly foreign-owned hospitals in China. You used to have a joint venture, and so I think we're going to see a lot of entry of private firms into the health area, particularly in hospitals. So I think things are moving ahead.
Last short question.
Thank you. Dr. Lardy, I'd love to outline a kind of a scenario where the renminbi internationalizes and understand what you think are the benefits and threats for America and the US dollar and the opportunities for China as well. So as well as working at Jefferies, in my spare time, I'm the local rep of the Irish funds industry here, and we're doing a huge amount of work right now on our QFII. So all the Chinese asset managers are internationalizing. Within the next year, we're going to have them all going into the interbank market as well. So there's going to be a huge amount of liberalization in interbank as well. We've got Shanghai Stock Connect going on. We've got our QFII going on. We've got Asian Passport. So it looks like we're accelerating the process towards convertibility of the renminbi. If all this happens, let's presume all this plays out, the renminbi does go convertible. What's the implications for America and the US dollar, and what's the implication for China?
Well, let me preface my response by saying I hope they don't go too fast on RMB convertibility, because I think they need some more basic structural reforms. I don't think you want to move towards full convertibility when you still have a lot of controls on interest rates. You don't want to move to full convertibility when the government is still pretty heavily managing the exchange rate. So I'm hoping that, even though they talk bravely about how quickly they're going to move towards capital account convertibility, I hope it is part of a well-thought-out sequence that avoids some of the pitfalls that might otherwise occur. Now, if they do get there, what are the implications for the U.S.? I don't think they're dramatic. For example, I don't think even if the RMB is fully convertible, it's going to be another couple of decades before there's going to be any significant use of the RMB as a reserve currency. So I think the dollar will remain the dominant reserve currency. I think it would facilitate more transactions, trade and other kinds of transactions in RMB, and I think that should be welcome, that we have a more diversified currency base for this kind of transaction. So I think that would be a plus for businesses, but I think a lot of people are thinking about what's going to happen to the reserves. Is the U.S. going to lose its role as a major reserve currency? I think that's decades and decades away.
Thank you, Nick. Could you please join me in thanking our speaker once again? Fast before you leave.
Yeah. Thank you.
Please, again, thank you for coming. Reminder, there are books outside if you want to pick up a copy. You do have to pay for them, but they're pretty reasonably priced. And please, this is for those of you who are not frequent attenders of American Chamber events, this is typical. Excellent food for the body and the mind. And we look forward to seeing you again. Another special thanks to a first-class presentation and Q&A from Nick Lardy. Thank you again. Good afternoon. Stay dry.